We have an incredible lineup of speakers.
Martha Stewart, everyone.
We welcome to the stage Akon.
Former First Lady of the United States.
Every single one of them is an explorer.
Hello, everyone, and welcome to episode 4 of Elevate Live. My name is Razor Suleman, and I am your host for today's show. At Elevate, our mission is to unite the world's innovators to solve society's greatest challenges. And in the era of COVID, raising capital, when we hear from our founders, is really challenging. It's so important to get our high potential tech companies in our ecosystem the capital they need to continue to scale, continue to grow, continue to build globally relevant tech companies right here at home. And so I'm so excited to welcome our guest today and talk about a topic that I think is so important, which is founder-friendly financing. Since our show last week, lots has changed in our ecosystem, right here at home. We lost 111, made the announcement that they are permanently closing their doors. They were such a staple in the tech ecosystem, launching companies like Borrowell, Maple, and Wealthsimple. We wish the best to Siri and her team. Also, some good news, the government has continued to extend benefits to small and medium-sized businesses. If you are having challenges with your rent this month or for the next 3 months, please check out the Government of Canada's rent relief programs where they offer up to 75% of rent relief. We want to do everything we can to make sure that companies are staying afloat during this difficult time. For those of you who tuned in last week to see our media mogul, Kara Swisher, join us on last week's show, next week, we've got her partner in crime, Scott Galloway, NYC, New York Stern professor, author, and a guest. Him and Kara did their show, Pivot, live at Elevate this past September. We are so excited to welcome him back to Elevate Live, where he will talk about crisis management. Today, we are talking about an important topic, founder-friendly capital. I believe that founders need to explore as many alternative sources of capital, especially ones that are less dilutive and keep them in control. I'd like to encourage everyone to join in the conversation. We are monitoring all social channels. We want to make this as engaging and as interactive as possible. So using the hashtag Elevate Live, please post your comments, your questions. And if you have a question that you'd like to ask our guest today, they will be doing a live Q&A after our conversation. You can go to the QA button on your Zoom browser and post your questions directly to our guests. Also, I'd like to just share a little bit of a story around my experience around raising capital and some of the lessons that I've learned. Previous to Elevate, I was the founder and former CEO of Achievers. Achievers was a SaaS enterprise company based here right in Canada. It had grown to 110 countries around the world. But where we got international or national acclaim is when we had raised $30 million from Sequoia Capital. Being the first Canadian company to do so, a lot of founders had reached out to me around, Razor, how do I do that? How do I get the attention of a Sequoia? And what I would now tell founders is don't do what I did. Sequoia Capital is the least founder-friendly sources of capital. They will take control of your board. They will put onerous terms on your board seat, and they will look to find one of their friends to replace you. So instead of doing that, what I encourage all founders to do is find the best sources of capital. And in my opinion, that's customer revenue and financing. Look at renegotiating your terms where you get more of a deposit or more money up front. Modify your business plan or business model so that you do get as much customer money so that you continue to grow revenue. Second, I would encourage every founder to look at every government program from FedDev and IRAP to the ones that were released around COVID. Make sure you take advantage of them. Often they are non-dilutive, very low interest bearing, and some of them don't even require a payback. Third, I would look at bank capital, bank financing. All of the banks have gotten into the lending game to the startup community. What I would encourage you to do is chat with them, but make sure you don't offer a personal guarantee if you can avoid it. Make sure it's on the merits of your business and not your own personal credit. And then once you've exhausted those, again, chat with the companies that are providing alternative sources of financing. We have the 3 best firms in the country on today's show. We're super excited to learn a little bit more about how each of them is providing the much needed capital our startup community needs to continue to grow and scale. We have Michele Romanow, co-founder and president of Clearbanc today. We've got Alkarim Jivraj, the CEO of Espresso Capital, and we have Nejatian, the VP and GM of Shopify Capital. All of you, welcome to the show. We're going to start our conversation off today with our dear friend Michele Romanow. She is a dragon on CBC's hit show, Dragon's Den. Michele is one of my favorite entrepreneurs. She has started several companies way back before it was even cool to be an entrepreneur. Michele was starting companies. She's had a number of exits, and now she is leading the force with her partner in life and in business, Andrew, at Clearbanc. What I love most about Clearbanc is they take the bias out of lending. They look at the health of your business, and that's why they fund female entrepreneurs at 8 times the rate of the average venture capitalist. Michele, welcome to the show. Tell us what founder-friendly capital means to you.
Yeah, well, I think I get a lot of this from my own journey as a founder. I mean, I have been now a founder for 15 years. For the first 10 years of my career, no one would give me money, and no one would give me money on terms that made any sort of sense at all. And so I spent years pitching to VCs looking for options. And it wasn't actually until I had an exit to Groupon that I could start investing and really thinking that I could kind of change the rules. And so one of the things that happens on Dragon's Den is that we see 250 pitches in 17 days, like 10 a day, just back and forth. And what I was seeing was that founders were giving up an extraordinary amount of equity to effectively go buy Facebook and Google ads. And so they're like, look, we're on the show. We need 100 grand. We're willing to give up 10% of our company. And I was like, this isn't a great deal for either of us. This isn't a great deal for me as an investor and for them as a founder to give up kind of control. And so on the show, this is 5 years ago, I said, look, we're going to just test a different deal type. I'll give you the 100 grand you're looking for, but instead of taking 10% of your company, I want 5% of your revenue until you pay me back $106,000. And this really wasn't debt. There was no fixed payment timelines or personal guarantees. It was like, if you use my capital to grow, you get a bigger business and I get my capital back a little bit faster. And if your business slows down, I'll wait it out for the journey with you. And today, that became the basis of what Clearbanc has done. We've expanded way beyond funding ad spend to every different category. We serve e-commerce companies. We now serve B2B SaaS companies. And we've invested over about $1 billion in 2,500 different companies. And so founder-friendly funding should be fast. It shouldn't take forever. It should be flexible. It should not have personal guarantees. And it should be done using your own data.
Awesome, Michele. Thank you. Next, we have Alkarim Jivraj, the CEO of Espresso Capital. Alkarim has been financing startups across the country for most of his career. He's ran a VC firm. He's ran 2 investment funds. And now he's leading the charge at Espresso Capital, whose primary focus is lending to scale up SaaS companies across North America. Full disclosure, I am a proud investor at Espresso Capital and a former board member. Alkarim, what does founder-friendly financing mean to you?
Hey, Razor, thanks. And it's great to be on your show. Founder Friendly for us is really built into our DNA. Our mission is literally to keep founders in control of their destiny, of their fortune, by enabling them to retain greater equity ownership in their businesses, particularly at critical moments when they might otherwise suffer excessive dilution. So, that is fundamentally us. It's also embodied in our culture and our values. We want to deliver a wow experience to founders at each touch point. Raising money is it's time consuming. It saps your soul sometimes. And so for us, we want companies to get through that experience quickly. So giving access to capital quickly, when they need it on terms that are fair and flexible. And for us, really founder friendly, the ultimate measure of founder friendly is, when the company founders say, you made a real difference when it mattered to us. We would not be here were it not for you. And so that to us is founder friendly.
Awesome, Alkarim. Thank you. A VC once told me that dilution was the solution. And just because it rhymes, it does not mean it's true. That's good for them, but it's bad for the founders. It's bad for your employees. It's bad for your management team. It's bad for your early investors, the ones who bet on you first. Make sure you preserve as much economics in your business and not overly dilute yourself, especially in those first early years where the capital costs so much. Okay, now we're going to go over
You
to...
said that about pollution, and that was not true. The dilution is not the key.
Fair point, Michelle. Kaz, we're going to go over to you. Kaz has been an entrepreneur. He started his own alternative payments company, Cash. I love the name. From his basement and grew it over to 100 countries around the world. Today, he's the GM and VP of Financial Solutions at Shopify and has recently launched Shopify Capital. Kaz, welcome to the show. What does Founder Friendly Capital mean to you?
Thanks for having me. I think Founder Friendly Capital just means that the capital wins when the founders win. And that could mean different things in different circumstances, right? So when I was starting my startup in 2012, for me, that meant getting large equity checks from traditional VCs because I thought my incentives were aligned. But that's for a very, very small percentage of businesses. Most businesses are not designed to be to fit well in a VC portfolio or to have your investors be aligned in your interest. The great majority of businesses that get started every single day don't need a $10 million Series A check. And so they don't have to take the complications of that. So for us, founder-friendly capital means us being on the same side of the table as the founder. If you're a small business, I need a couple $100, great. If you need $1 million, great. And we want to get paid when you get paid. If you don't have sales, that's fine. Take a bit longer, establish your business, and take as much time as you need. Not every business is fit to be a VC-backed business. And that's okay. A lot of good businesses are founded without VC funding.
Awesome. Well, listen, you can see why there are so many advantages. And this is a really misunderstood category. The beta kits and tech crunches of the world write about VC financing, but we need to make sure we preserve the economics. And that's why today's show is so important. Michelle, we're going to talk about you and Clearbanc. You guys have access to 2,500 companies. You're integrated into the different web properties of Facebook, Amazon. You have a ton of access to data. COVID changed everything in the funding landscape. What is the impact that you've seen in the startup landscape post-COVID?
Yeah, so I'll give you a couple, and I'll kind of span the spectrum of what we've seen across the funding and startup landscape. And so first of all, generally we have seen companies that have presence in e-commerce, and Kaz can probably talk about this too, have done pretty well. Now I think every business that starts today is going to think about an e-commerce presence. But here's where kind of the funding sources have gone. I think when you look at equity, investors have become quite skittish, and that's because we've seen enormous fluctuations in public markets. And then it's really you're in a very disadvantaged place as an entrepreneur because you've lost a lot of the tools that you could use to, raise a really good round. And so Right now, VCs are playing triage, so they're looking at saving companies, not helping new ones. The second thing is that you don't have the ability to meet them in person. And so you can't give that same compelling story that you would normally be able to give. And the lack of being able to do that makes it much harder for you to create a bidding war and a higher valuation for yourself. And so I think equity markets are in a pretty tough place. And so I really recommend that this is now not the time to be fundraising unless you absolutely need to. On the debt side, we have seen many companies that had warehouse lines with banks have their warehouse lines pulled or severely diminished, and this can generally happen. We've also seen that in the venture debt space where MAC clauses have been pulled, saying there's a material change in the market in your business, and so you no longer had the capital that you thought you had. And then there has been a lot of folks in the space that have actually just stopped providing capital altogether. And so that, the Cabbages and Funding Circles and Squares of the world, because they had their books that were so heavily brick and mortar based, it's been very, very difficult for them to keep providing capital, which is why I think, certainly Espresso, Shopify, and us are in a really unique position because the options have really changed for founders.
Awesome. Thank you, Michele. Alkarim, I know Espresso has been focusing on financing scaling SaaS companies across North America. What advice are you giving your entrepreneurs today when it comes to raising capital?
Well, I think to echo Michele's sentiments, this is a tough time to be raising new money for a variety of reasons, obviously. And so I think you need to really look at your business and really understand what this downturn is going to have on your business. Do heavy duty stress testing and understanding your worst case scenario. And fundamentally, however you fund your business, get some more debt, get some of the government fundings, the Paycheck Protection Program in the US, the equivalents in Canada. All of those contribute, but fundamentally, you really need to look in the mirror and prepare for a worst case scenario. We're later stage. Our new check sizes are going up to 20 million. The latest company we funded is about 50 million ARR. And so, depending on where you are, the situation for you is different. But, our companies grew last year at about 50%. We think this year that growth is going to be approximately half. And if your cost structure was built on 50% growth, it needs to be adjusted to accommodate this lower growth rate. And so I think that that's really where a great deal of the focus has been on our portfolio. And in terms of new conversations, we want to make sure that new companies we fund are really built for a worst case scenario, because I think, we're sitting right now, I think, in the calm between, the second tremor. We think that it's not unreasonable to expect that there's going to be a second wave of infections. And so the impact to society is going to be quite severe if that happens. And we just want to make sure that our companies and the companies we work with are prepared for that worst outcome.
Alkarim, listen, at $20 million, I mean, you can be taking out, that's a healthy Series B. Is Espresso positioned to help founders even avoid going to the equity markets? Could you effectively be a Series B, or do you look for a combination of both debt and equity when you guys invest?
Yeah, so I think my view is if you used so there are two ways people use debt, right? One is they're principally equity financing, and then a bunch of things go wrong. The equity markets are not there, or their investors are not there, and they need a runway extension while they fix their problems. And so venture debt becomes an option. And we certainly do a lot of that work today. But we also say to entrepreneurs, think about debt strategically. If you imagined you raised 1/3 debt and 2/3 equity on every round, then you would probably, by the time you get to your D round, own 25% more equity in your business. And we think that is transformative from your net worth perspective. So I think that the more you think of debt as strategic, and more you think of your debt funders as long-term partners as opposed to near-term, short-term fixes, I think it drives better outcomes for entrepreneurs. And it doesn't matter if it's in good times or bad. I think this holds through the cycle.
Yeah, Alkarim, you nailed it. I think not having the right capital mix, my journey, I focused exclusively on equity financing. And when I looked at the math after the fact, had I had a healthy mix of debt or revenue financing, maybe about a third and 2/3 equity, myself, my employees, my shareholders, early shareholders would have made $20 million more. Bidikit did a great story on the lessons that I've learned. We're going to share it with our guests following today's show. But we're going to go over to you, Kaz. Shopify has been crushing it. The pride and joy of the Canadian tech community is it now the second most valuable company in the country. Amazing. Tell me about the newly launched Shopify Capital and how you guys have been helping entrepreneurs.
Yeah, I mean, the way we think about it is this. Now is the best time to start a business. It literally is the best time. And that's just not today because the economy is not doing that great. But Disney was started in the tail end of a recession. IBM, GE were both started in the middle of recessions. Airbnb was started in a recession. If you want to start a company, now is a really good time. And Shopify has only one job, which is to help people start and grow businesses. So the first thing we did when we thought the world was going to panic a little is our CEO went out there and said, we're going to commit $200 million into businesses on Shopify with Shopify Capital. So we weren't going to back down from the market. We weren't going to slow down. We're going to start giving out more funding to more businesses. And in 2 weeks, we launched Shopify Capital in UK and in Canada. So if you're an entrepreneur in Toronto or in Montreal and you want to start a business now, not only will we give you the tools you need to start a business, we'll also give you the money. Anywhere from $200 to $1 million, whatever you need, we want to be on your side. And I think that's been a special part of Shopify's growth overall. It's that we do well when our merchants do well. So we think this is a great time to become a merchant. And because of that, we don't really think of it as a bad time to give funding. We actually think it's a great time. And we've seen that across our entire portfolio, that our merchants are doing very strong. Like the e-commerce is growing really well. And that's both true in Canada and the US and globally. So that's been really a part of our key thinking is that we don't really think of it as how much money we're going to get back because of money we're funding in these businesses. We think of it as it's our job to help start as many businesses as we can. And this is just one small part of it.
Awesome. Michele, I know when you guys started Clearbanc, you talked about how founders were approaching you to basically give up equity to buy Facebook and Google ads, which is a very expensive cost of capital to fund the necessary marketing investments scaling companies need. Mm-hmm. I know now that you guys have pivoted in this environment. Talk to me a little bit about how your business model has changed in the current environment.
Yeah, I mean, we're viewing this a lot in the same ways as Kaz was talking about. We think now is the time to accelerate. So it's to, make sure that we can serve as many platforms as possible. And as many types of businesses. So, a year ago, we were just funding e-commerce businesses. Today, we're funding a ton of B2B SaaS companies and different markets as well, and people that are on multiple different platforms. And I think you bring up, a really good point around what different sources of capital should be used for. And so I've never thought of any source of capital as bad per se. I just think that they're different price points. And so equity makes sense when you are taking an insane amount of risk that's true 0 to 1 risk, right? Let's talk about building a vaccine or not. There's 200 vaccines now being developed. And one of them's going to work and one of them's not going to work. And you're going to need, tons of data scientists and tons of scientists to do that. That is true equity level risk. But when you look at other things that many companies are spending money on, one of them being user growth, so that typically translates into digital advertising. That's stuff that looks like sales commissions. Those are things where you actually understand far better that I'm injecting $1 and I'm getting $2 out. And in those situations, it makes a lot more sense to use cheaper forms of capital, which is revenue share capital like Clearbanc or or Shopify, or it's traditional debt. And so that's how I would think about those two things.
Yeah, I couldn't agree more. I think now more than ever, founders really need to understand their unit economics, understand their risk profile, and really where they're deploying the capital, because equity can be very expensive. VCs, Alkarim, this question is going to be over to you, but VCs are basically looking for a 40% IRR on their capital. I know that, again, Espresso has been writing pretty large checks to both Canadian and US SaaS companies. Give me a sense of the average check size and what the cost of that capital for scaling companies looks like.
For sure. So, we've got this model that says the amount of leverage we'll give you is going to depend on, think about one axis. If you spend $1 on sales and marketing and you get 80 cents, 70 cents, 50 cents in margin, and then the other axis is, what growth rate you're growing at. And so we'll give companies anywhere from 12 to 24 times their monthly recurring revenue in a growth facility. And that's enough to fuel you for a year. And if you deliver on that year, you've got enough cash flow to do it again next year. So, it can be a very powerful, non-dilutive way to grow. In terms of pricing, I'd say that, your all-in cost with Espresso is probably going to be in the 13, 14% zone. And, some of it can be current pay, some of it's paid at the back end. The one super important thing to remember here is we're really long-term investors in our clients. We're writing 5-year loans. There is no amortization of the principal during the life of the loan. It's back-end paid. And so all you're really paying is the monthly interest payment. And therefore, you've got a ton of capital to use for growth in that time horizon.
That's really interesting. Again, I think VCs get a lot of attention, but at 40%, to be able to find a debt partner at 13%, it's literally 2/3 less expensive to get $1 of capital. Kaz, let's talk a little bit about Shopify. I know financial services have been around for a number of years. How has COVID affected your go-to-market strategy?
Honestly, not that much. You have no idea how little I care about what the IRR is on our capital business. That's not what I think about when I wake up in the morning. I think about how many businesses we can help start. So what we have done is accelerated a bunch of things that we think can be helpful to merchants at these times. So we extended we allowed them to sell gift cards or extended our trial programs. But overall, it hasn't made a significant dent in how we think of our capital business generally, other than the fact that we want it to be more broadly available because other people are stepping back. But generally speaking, every chart I look at tells me that our merchants are doing great, and we're happy to fund as many of them as we can to grow. One interesting thing that I think is odd difference between what we're talking about the debt and equity capital is that, look, a job of a VC is to, figure out what the alpha risk is, right? Like how a company does well compared to everything else in the world. But that's not really what we think about. We don't think of, hey, is Knixwear, which is one of my favorite Canadian companies, are they going to do well, or is some other female fashion company going to do well? That's not what we think about. We don't think about picking winners and losers. We make decisions on each individual business. And we're perfectly fine giving financing to 2 fashion businesses because we don't think that there's only room for one winner in this space. In lots of businesses, there can be multiple winners, and we want to be on the side of all of them. And I think that's actually a fundamental difference, not just about whether it dilutes you or not, or whether it comes with a personal guarantee or not. Those things are all bad. You shouldn't take those things. But another important thing is will the person you're getting funding from change their mind later on because they want to find a competitor of yours? And will they think there's only one winner? And that, I think, is as important as the cost of capital. Who are you taking money from and whose side are they on is actually an important question.
Awesome. Thank you. Can you give us a little sense, Kaz, around average check size, how long it takes for you to deploy the capital, what that cost of capital might look like for entrepreneurs?
Yeah, so let me give you an example of Canada. So we launched Shopify Capital in Canada last week. Within the first hour, we had already funded businesses. So, we fund businesses like very quickly. It's not days, it's minutes. And our range is relatively high. On the low end, we'll fund, someone who's just started and wants $200 to buy Facebook ads. On the high end, we'll fund someone who wants $1 million for growth or inventory. And we'll fund you multiple times. You may need $200 today, but $1 million 6 months from now, and we'll cut you both checks.
Awesome. Michele, I know that you guys coined the term, which I love, 20-minute term sheet, billboards on the side of Highway 101 in San Francisco. I love it. Talk to me about the pre-COVID, post-COVID world. Give me a sense of how you've seen the funding landscape change. What are you guys looking for now, or advice you have for founders looking to raise capital in a post-COVID world?
Yeah, I think I talked about how kind of these multiple buckets of capital has really changed. I think now is the time to realize that founders need diversified and safe sources of capital. And so if there was ever a time to read the contract and the fine print, it is 100% now. All of those clauses on the back pages of your contract really do matter. And so, a MAC clause where a bank could say, look, your business's material changed and now we're taking back our capital. This is exactly the economic circumstances where those things start to happen. And frankly, those stories just crush my heart, right? I am 100% of, the believer that it's entrepreneurs that build our future. They build the best version of our future. And we should be using the data that comes from their businesses to be funding them. We shouldn't be using, these heuristics that have been used for so many years, which is, did you go to the right school? Are you part of the right friend circle? Do you know the right people? Which is largely how, the entire equity world has operated. And it's not because they were bad people. It was just because, if you're a human to human business, you could only go so far. And so I'm very optimistic about what we can do with the use of data, and what's going to be built out of this phase, because we are no doubt seeing an extraordinary amount of suffering. We're probably going to see the largest health crisis in our lives. We're going to see the largest unemployment rates in our lives. And I think being part of that story of rebuilding and this next generation of entrepreneurs is the most important thing that all of us, both in the capital world and as founders, should be focused on now.
Awesome. Thank you, Michele. Alkarim, we talked a little bit about, venture capital looking to get a 40% IRR. On the other end of the spectrum, we've seen a number of our Canadian banks getting into the tech lending space. Talk to me a little bit about how Espresso is differentiated than what you might see if you go up to talk to your banker. How do you guys differentiate?
For sure. So maybe take one step back, if I may. The venture debt markets in the U.S. are much more mature than in Canada. And, there have been these bank lenders that have been around, Silicon Valley Bank and so on, for a long, long time. And they're really providing you the senior layer of your debt stack. If you want to think of it that way, typically it's going to be up to 6 times MRR for a SaaS company. And then there have been non-bank lenders like Espresso out there who would provide you with either the next 6x MRR, so the junior layer of the debt, or a single unitranche solution that combines both. And so I think that's kind of understanding one versus the other. They're not the same thing. There's a reason why their rates are different, and there's a reason why their risk appetites are different. But I think the other thing you need to appreciate is going beyond the price. What is the underlying difference? The quantum of leverage, obviously, is going to be different between a venture debt lender like Espresso and one of the banks. The underlying conditions, including what are the covenants, are going to be very different. Ours tend to be very covenant light. What are the conditions of default? Michelle's back clauses and their willingness to use it versus, focused on your reputation, and you appreciate that, you've always got to be customer centric. Otherwise, you're going to have a hard time, getting the next loan. And then the other elements are the terms of the loans and the amortization. So how long do you really have this money, regardless of the price, and will it actually move the needle? Or did you get this loan, the price looked really attractive, but you only got a year and a half of effective capital, and ultimately you needed to raise more equity, and what was meant to be less dilutive turned out to be actually more dilutive because you didn't end up with capital for the length you thought. So I think those are the things around differences between banks and non-banks. And then the other one goes to the depth of domain expertise, right? If your lenders know what they're doing, then they are prepared for down markets. This is part of the cycle for them. If your lenders really are not experienced at doing this kind of work, if this is not a big part of their business, in a down market, the head of commercial banking can say, you know what, let's find all of our poor performing lines and let's get out of them, and bam, they're no longer in your business. And so I think that the other part that really matters is having a debt provider that knows what you're doing, that's got an appetite for the downside cycle of your business when it happens, and is there to be a good partner when you need to work yourself out of a tough situation. So I think that those are the differences that you need to keep in mind.
Awesome. Yeah. Thank you for helping us understand the differences. Okay. For the last few minutes before we go to our audience questions, we're going to do some rapid fire for our guests today. I'm going to throw out a question, and I'd love for you guys to give me one word, the first thing that comes to your mind. We're going to go Michelle, Alkarim, Kaz. You ready? Okay. Number one, does your firm take a board seat?
No.
Never.
Wouldn't know what to do with it.
Awesome. Number two, do you require a personal guarantee, Michelle?
No, being a founder is the hardest job in the world. You shouldn't have to put your personal assets on the line.
What's a personal guarantee?
Yeah, no, this is stupid.
I love it. Okay, another question. This is my own curiosity. Who's your favorite Canadian startup? Who are you rooting for? Other than your own firm.
Oh my gosh. Who? Borrowell, upstairs from us.
Clearbanc on this panel.
Thank you.
I said Clearbanc, but I also want to give a plug to Nixware, which I think is an insanely good company that every Canadian should be proud of.
Totally.
We agree.
Joanna and I are doing this women's entrepreneurship project together. Amazing company. Would 100% echo Nixware.
I'm watching it on Instagram. I'm very jealous.
Okay, next up, who is going to become Canada's next unicorn?
Hopefully us.
Well, you know what? There's a great little company in our portfolio called Spartan Biosciences, and they've got this rapid COVID test. And obviously the technology platform can apply to a whole range of things. So we're hoping that they're going to be the next unicorn.
I was going to say Spartan, and then you stole my idea. I don't know. I've been a very bad angel investor, so I don't know.
I love it. Thank you, guys. We're going to go to our live audience, but I just wanted to recap some of the key learnings from today's call. Make sure that you are aligned with your investors. The more you grow, the more capital should be available. No personal guarantees. It's risky enough being an entrepreneur. Make sure that your investors are not taking overly amount of control of your board. And if they don't want a board seat, do not give it to them. Again, make sure that they are long-term partners for you. So thank you guys for sharing that. We're going to go to our live audience Q&A. Stephanie K from our Zoom asks Alkarim, what correction strategies, if any, do you have for an entrepreneur that it may have given up too much equity at this point in her raising money in her company? What can she do, if anything?
That one is a really difficult one. I think there's you could consider a recap where you'd kind of do a wholesale trade off of your existing investor base. It also depends on how the business is doing. So yes, you may have given up a lot of equity, but are you growing very rapidly? And can you grow your way to kind of building wealth? Or have you given up a lot of equity and the business is not doing so well? And in that situation, you really need to look in the mirror and say, does it make sense for me to continue down this path, or should I consider selling and do it again with lessons learned and build something bigger and where I own more of the upside?
Awesome. Our next question is from Chris Evans from New York. He has a question for Michele at Clearbanc. Do you guys offer any non-financial support to help companies grow?
Yeah. So one of the things that we thought was really important that equity investors pitch a lot is this idea that they have, a network and folks that can help. And so we put together a team of venture partners last year, folks like Neil Blumenthal and Gary Vaynerchuk, like people that have built pretty substantial e-commerce brands that can help our founders. And we've also built a pretty large partner network of, all the different folks, email providers, like different vendors that can help you grow your business. And so some of those are direct relationships, some of those are discounts, but for sure.
Awesome. Our next question is for Kaz. It's from Dr. Andrew Liu from Canalog. It's a cannabis company out in Mississauga. Do you guys have any restrictions around what types of companies that you lend to? Would you lend to a cannabis company?
Yeah, I don't think we actually do lend to cannabis companies, but I think we only lend to companies in Canada that we can support on Shopify payments. So we do have restrictions on regulated industries, but we don't have restrictions on size or revenue or check size. But on industries, we do.
Got it. Great.
But I recommend either Espresso Capital or Clearbanc if either of them do lend to cannabis companies. They both seem great.
Makes sense. Okay, we've got Barbara W. from New York has a question for Michele. What type of data do you look at to make financing decisions?
Yeah, we look at the data. Effectively, what we did is we tried to take what VCs did and automate that process. So, we're looking at your payment processor, your bank account, and how your ads are converting to really determine kind of your LTV to CAC ratios. So those are the data sources that we require. And just on Kaz's point, we also have the same challenge on cannabis companies. And I think it's more the thing where we need the payment processors to come on board, and then we could probably start funding some of those companies. But it is something that we look into fairly frequently.
Awesome. Question back to you, Michele, from Amanda A. has a question for Michele around female founders. Any particular advice specifically for female founders around raising capital?
Look, I think it's a hard time for all founders, and it's never helped me to kind of think that I was disadvantaged in any way. I think that this is just a really tough environment, period. It's one of the things I'm really proud of at Clearbanc is that we funded so many more female founders, not because we did anything at the top of the funnel, because we actually took the bias out of how we make decisions. But look, on aggregate, female founders have built incredible companies, often with stronger unit economics. And so, in especially economic uncertainty, this is often the time that those companies can really pull ahead. So just good luck.
Awesome. We've got Ian T. from Toronto for a question for Alkarim. I know that Espresso focuses on SaaS lending. You chatted about MRR being a key metric. What other metrics do you look at when you're making an investment decision?
Sure. So margins and growth rates are pretty important. Your churn. We're really looking at all of the unit economics that help us understand, how sticky this revenue is, because fundamentally we're giving you some sort of a discounted value of your future revenues in a loan. So we'll look at all of the key unit metrics. We're really trying to make two determinations: how sticky is that revenue? How efficient is your sales engine, and how efficiently are you growing overall? Those are ultimately, if you want to boil it down into the metrics, they all roll up into those three things.
Great. Thank you, Alkarim. Catherine A. from Vancouver has a question for Kaz. We know you don't lend to cannabis companies. Is there a particular area of the type of companies? I know it's e-commerce generally, but is there a specific area of focus that that Shopify is looking to deploy capital in?
Yeah, so it's not just e-commerce companies. We'll fund like any company on Shopify, including brick and mortar retailers, of which we have thousands. So we don't really think of this as being if you were a VC, I would say we're stage agnostic. Like I'm actually not even I don't even know like what the stage limitations are. We have limitations on our one-time funding. So if you need more than $1 million today, we're probably not the best option for you. But other than that, we don't really think about it in the way that traditional investors do. We tend to be the best source of funding for businesses that are selling things. We just tend to be the best. Like that's what in our DNA. If you're a commerce company, the odds are we're a very, very good source of funding for you. If you're a software or a services company or a SaaS company, we're probably not the best source of financing for you. But that's generally the limitation we look at.
I think you brought up a really key point. I think entrepreneurs need to take it upon themselves, do the research. As you can see, we've got great investors on our call, but they very much focus in the areas that they're experts in, the geographies, the check sizes, the business models. And so I think knowing who to approach when you're looking for alternative sources of capital is key. Okay, Shannon, we've got a question from Montreal for Michelle. Do companies you invest in automatically get access to your partner network?
Yes. Yeah. No, that's part of being a part of being in the Clearbanc portfolio.
Okay, great. This one is to any of our guests from James over in Edmonton. What are your predictions for industries or companies that'll come out of COVID even stronger? Actually, love to hear from all three of you.
I think I'm the anti-pattern. I feel like in every room I'm in on this issue. Look, I think a whole bunch of things are going to come out stronger, and I really, really don't think it's going to be like industry specific. I mean, look, if you were selling masks, you're doing gangbusters, so yay to mask sellers. Many of them are on Shopify, but I think there are founders in every sector who are going to win because the world is going to change and our needs are going to change, and the founders that can adapt to that are going to win the most. So I would not pick an industry and say this is going to be the industry that will win, because that's just not how founders work. Like, I think you should just do what you really, really want to do, and that tends to work out. And I think it's going to work out better now than it would have like a couple of years ago.
Great, thank you. Our next question is Hannah from Toronto asks, Razor, I'm a first-time founder. I read your article in BetaKit and found it helpful. If you had to go back and do it again, what would you do differently? Oh my God, we don't have enough time on this show to talk to you about all the lessons that I've learned. Look, many of them we really did talk about today, and our guests did a fantastic job. But I think the mistakes that I made is that I let my ego determine who would be the best financing partner. We were in a very fortunate position at Achievers. For 8 years, we bootstrapped. A lot of founders don't know what bootstrapping means today. It means keeping your expenses low, focusing on customers, and getting as much cheap, non-dilutive, non-control taking capital as you can get. We did get debt financing, and then when we were growing at 100% year over year, we were lucky to have our choice of VC. We were able to get term sheets from Sequoia, Excel, Kleiner, and Battery. And I should have picked Battery Ventures. I love the guys that run that firm. They were really aligned to the vision of the organization. They understand what we were trying to accomplish. But again, I'd say my ego made me pick Sequoia, so don't do what I did. Find not the firm that you're interested in, but the partner that you're going to be working with every single day. Because if you are not aligned with that partner, you are going to have a really tough existence as you grow, or you're just misaligned around how to continue to grow and scale. So I'm super passionate about alternative sources. I'm glad that our partners, our guests today shared a lot of their wisdom, and I'm going to go over to them for our last few questions. We've got Rohit on our Zoom chat asking Michele, what advice do you have for non-technical entrepreneurs with an idea but no technical know-how?
This is a great question. So there is a lot of things you can do. First, I am shocked at like how easy it's actually become to like code and put components together. And now there's like incredible platforms like Shopify. Like, to just illustrate this, in 2010, when I started an e-commerce website, we were using like terrible Magento products. It took 3 weeks to get a payment processor. It took 4 weeks to get a website. Like, all of that can be done with Shopify, Stripe, a credit card, AWS, like incredibly simply. So the first thing is you can get pretty far without a technical co-founder. Code also got a lot easier. So if you're technically inclined at all, this is a great time to like invest in yourself and like learn. And then the third option is really finding someone that you think you can build and trust with. And so I've had, some incredible engineers that I've worked with throughout my career. I always recommend this is like a good time to start a relationship, to see if it's working, and to see if you want to go into business with someone long-term. I used to suggest that people go to all the code meetups, which is where I met my first developers. And so now I'm sure there's an online forum, and referrals work really well for that.
Awesome. Thank you so much, Michele, Kaz, Alkarim, your insight. Thank you for your insight, your thoughts, your time today. I know there's you guys have no lack of things that you're juggling to build and grow and scale your business. As a token of our appreciation, Elevate has planted a forest in your honor, right? Didn't you wake up this morning hoping you'd get your own Michele Romanow, Alkarim Jivraj, Kaz' forest? It is in the Great Lakes region. Once we beat COVID, and we will beat COVID, we do have a climate crisis that we need to chat about. So know that each of you is doing your part with your own forest.
Thank you very much. When do we do the Elevate tour to visit the forest?
It's here.
Yeah. Kaz is in it. I love it.
I love it. I also wanted to thank our thousands of viewers today for tuning in to our lunchtime show. It's a true pleasure to be able to host you as you navigate and grow your businesses. Tune in next week where we have Scott Galloway, NY professor, thought leader, author, one of my favorite speakers, joining us next Wednesday, May 6th at 12 Eastern Time. To register, visit elevate.ca/live or look for a follow-up email. We'll send you all of the lessons from today's calls, links to each of our speakers, and to be able to register for next week's show. I'd like to have a special thank you and a shout out to our executive producer, Lisa Zarzechny, and her incredible team for producing today's show. And we want to encourage you to continue the conversation online using the hashtag #ElevateLive. Thanks so much. And take 1 minute. Tell us your show ideas. Tell us what you liked. Give us feedback. We always want to learn and grow. And so we really do read every comment. And thanks again, everybody. Stay healthy, stay safe, and let's take care of each other. My name is Razor, and I am out for today. Thanks so much.